Let's take a closer look at some of the market action with our reporters, and let's start with Abigail.
Well, Scarlett, there may not have been big moves for the equity indexes, but for oil, it's another story. Take a look at this. Oil, another risk asset, sticking with the conversation you all are having, down 4.2% on the day, the worst day in almost 2 weeks, on a bigger stockpile build than expected. On the quarter, now down 15%. This, of course, is a risk asset as well. It suggests and is a tell on economic growth. So the fact that you have oil lower and it's a less liquid one, investors tend to take profits there. It could be a tell for stocks. Take a look at this chart, a one-year chart of the S&P 500 normalized to oil. You see that they tend to trade last year for some of it in a somewhat correlated factor as fashion as risk assets. Oil leading the way higher and then leading the way lower. Right now, oil down 23% over the last year. The S&P 500 slightly higher. There are small technical reasons, Emma, to think the S&P 500 could climb back toward or above 3,000. But overall, this chart may just suggest there could be a painful reconnection for stocks to oil. Again, another risk asset.
From black gold to the real deal, Abigail. After a slip on Monday, gold is back in vogue, rising for a second day, and in fact rising for the last 10 sessions of 11, up more than 4% in that time. The trade war risks there, having investors look for safer, for higher ground, and so they're choosing gold. ETF holdings have also been rising. Last week they saw their biggest increase in some 2 years. And earlier today, Bloomberg Television heard from Paul Tudor-Jones, who said gold is his favorite trade for the next 12 to 24 months. He says it has everything going for it, given the trade environment and the fact that we may be looking at lower rates both here in the US and globally. He says that if gold gets to $1,400 an ounce, it's going to move to $1,700 an ounce pretty quickly. It's currently trading at $1,331 an ounce. Remain.
All right, thanks, Emma. Well, I guess this is partly tied into that, but financials, second worst performer in the S&P 500 today. The KBW Bank Index down more than 1%. Keep in mind, we had that Morgan Stanley's financial conference where they gave a lot of forecasts here. You had the CEO of Morgan Stanley, the CFO of Citigroup, all saying that their trading revenue, as well as some of their investment banking fees, would actually drop for the second quarter. Remember, just a couple of weeks ago, we had Jamie Dimon and Brian Moynihan saying similar things. Then on top of that, you have all this concern now that the Fed may be poised to start cutting rates. And of course, that's going to hurt the lending side of the equation. Lower rates and the flattening yield curve, of course, having a direct impact on net interest margins. Some analysts, though, they're saying that there could be a silver lining here. They point to 1995, 1998. That's the parallel they like to look at for the last big sort of rate easing cycle where banks actually outperformed. They outperformed in 95 and 96, the first 2 years of that easing cycle, and in 97 as well. A big key to that, of course, is this idea that as those lending rates goes down, that actually sort of prolongs the stronger credit cycle, which helps the banks in a way. And of course, loan growth. That was a big part of the equation back then. If the loan volume goes up, that could account for a little bit of weakness on the net interest margin side. Banks also going to be counting a lot on M&A activity, as well as improving some of those efficiencies, like scaling back on the number of bank branches and moving a little bit more to automation.